Tariff started today. Stock market is selling off again. Now it's still mid-morning. We're seeing some buying, sort of buying on the dips. I'm not so certain that that's going to hold. There's a lot going on. And mostly we have an executive that, for whatever his rationale is, wants to absolutely destroy everything. Plain and simple. And regardless of anybody's political beliefs, this is the direction that things are going. Rationale wise, as to why, who cares? This is the direction things are going. So the stock market is in the process of selling off, and I believe, based on the economy where we are right now, the stock market will go further lower. Just 2 weeks ago, the stock market hit all-time highs. I think it was on February 18th, depending on which index you're looking at. Since then, a drop of nearly 10%. That's a huge correction. There's still a lot more in the tank, I believe. When you look at the economy itself, it's already beginning to slow down. The consumer themselves slowing expenditures, saving more. This in itself, with an economy that is 70% consumer driven, when they start slowing down and saving more, where do the revenues come from to justify price to earnings ratios? They simply don't. So the stock market sells off. But then we get to factor in tariffs. Now, tariffs are a tax on consumers to pay for government expenditures, but those government expenditures are still going to trickle into the economy. Unfortunately, however, it's an inefficient way. And although it's a circle of sorts that the money still goes into the economy, inefficiently we get growth, slower growth. So ultimately what happens there is the consumer gets taxed further and stops spending more. So the tariffs really aren't going to play out well anyway. But then we get the backlash from all the international consumers who are saying, you know what, no more American-made goods, plain and simple. Fine. In an environment like that, what do you buy? Now I've mentioned this a few times. I think it was in December, January. I bought SHY ETF, SHY ETF, which is the 1 to 3 year Treasury bond ETF, one of. There are plenty out there. It's a tiny position. Like, not bragging at all. It's up. But SHY ETF doesn't really move big, but it does move consistently. Now, there are some variables that you have to take in place. First off, I believe the Federal Reserve will be scrambling to lower interest rates. And when you start looking at the charts that we have, SHY ETF specifically, oddly, we have interest rates that are very high right now relative to, say, March 2020, COVID. Yet SHY ETF is higher, which when you look at the mechanics of this, it's odd. But what I believe will happen is the Federal Reserve will have to lower interest rates rapidly, and SHY ETF will skyrocket because of that. More so than, say, TLT ETF. Now, there are other short-term ETFs for 1 to 3 year, 1 to 5 year Treasury bonds that have multiples, but I'm not going to play that. This is an ETF that I had purchased thinking, you know what, the Federal Reserve is going to slowly, gradually lower interest rates, and I'll see some progression in price. Now, all of a sudden, because of the sledgehammer to every institution that we have, the Federal Reserve, my belief, is going to have to operate even faster. And because of that, SHY ETF will push higher rapidly to a certain point. There's a big asterisk there, though. 10 days, we may see a government shutdown. So I'm getting ready to pull the trigger on more SHY ETF, but I want to see what happens with the government shutdown first. I'm not getting in front of that. Regardless, people were asking me, where do I put my money? And I've been saying the same thing consistently, that long-term Treasury bonds are a good place to start simply because when the Federal Reserve does lower interest rates, when the economy does get shattered, those Treasury bonds that you're buying now with 4.25%, 4.2, which I think I saw the 10 trading at about 4.15%. Just yesterday I was talking about 4.3%. Had you bought those treasuries, those 10-year treasuries at 4.3%, they're worth more today because the yield is 4.15%. You're ahead of the game. Eventually, the Federal Reserve will drop short-term interest rates, and this will affect the long end of the Treasury yield curve, which the 10 could easily drop to 2.5. If you're buying today at 4.15, 4.13, wherever the 10 is at this right at the moment that I'm making this video, that's going to be quite dear. But it's that short term that I'm looking at that I think we're going to see a rapid pace. That what we're seeing is a swift move out of stocks. Savvy money is buying up treasuries, and the opportunity of a bigger move in SHY ETF upward might outpace TLT, but I'm really hesitant because of the government shutdown. I believe that that's an asterisk that you got to take a look at. Let's jump in. I'm going to break down the economy real quick, take a look at charts on the stock market, break down where the consumer is, and show you the chart on SHY ETF and why I think this thing keeps going. Want to point out one thing again. I mentioned this yesterday. I'm going to continue to point this out. First and foremost, my numbers are growing rapidly, and I believe, and I kind of saw this coming in, that when you break down what's going on, what's happening, and at the pace that I'm doing things because of the pace of the economy, my numbers are growing. That for the longest time, I wouldn't see much growth simply because it was steady as you go, steady as you go. Now people are searching for answers, and I'm popping up. Thank you so much for following along. Substack is my primary place. Now there's a link in my profile. There will be a link in the meta description down below. If you're seeing this on YouTube, thanks so much. If you'd like to get rid of the advertisement, sign up for the Substack newsletter. You get this email straight to you. It's the same video. I'm repurposing this at Facebook as well. Here is a look at, this is SPY ETF, SPY ETF, the S&P 500. Pretty good indication of what's going on in the economy. As you can see, at the dead smack in the middle at the top there, that was just February, 18th, 19th, 20th. DIA ETF, SPY ETF, and QQQ ETF. Plus or minus 2 or 3 days, 1 or 2 days there, they all kind of hit huge numbers. Then we got Nvidia, then we got consumer numbers, then we got Walmart. It was just hit after hit after hit. And now we're seeing a sledgehammer coming in from Washington, D.C. This is just the beginning. And my position simply on this is I don't care about his politics. I believe he is hell-bent on just literally smashing everything, and I don't think he believes he's actually going to leave office on January 20th, 2029. I believe he thinks he's just going to be there and he's just going to break everything. And while I also believe he does have a valid reason to think that it's a good thing to have U.S.-made products made in the United States of America, I believe there's also outlying things going on that, and I've mentioned this in other videos, his rationale for all tariffs are because he wants to raise the price of oil coming from Canada so Saudi Arabia and OPEC can sell more here in the United States. I believe all of this comes from that. And I also believe he's getting paid for it. Fine. And you could disagree with that. It doesn't matter. We have 25% tariffs, 10% on energy coming from Canada, who they dominate U.S.-made U.S. imports. I think he's getting paid on it. We know that Jared got money from Saudi. He's got a coin. That's policy. Plain and simple. Disagree if you want. Who cares? This is policy. I believe he's artificially going to push Canadian oil higher so that Saudi Arabia can sell more, and he'll get paid from it. Given that, the ripple effects will be massive. And we're seeing this play out. Stock market is taking him seriously. Wow, this is not a negotiating tool. This guy wants to shatter everything. One thing about the stock market is it only wants consistency. It only wants predictability. We do not have that at all. So let's take a look at one of the biggest starting points for me, the money supply. Growth rate on the money supply month over month for this quarter, flat as a board, infinitesimally small. There was an absolutely tiny move higher for the money supply. We got the report, I think it was January's report we got in February, just a couple days ago. And basically, there's no more growth in the money supply, but we're also seeing incomes, the rate of growth there declining, which that takes the rate of growth of expenditures, and we're seeing that decline. What is the consumer doing? Saving more. We saw a spike higher in the personal savings rate. The consumer, I believe, is tapped out. So I just showed you a couple quick charts. Let's break this down real quick. The money supply is the fuel for the economy. And if it stops growing, that means people are no longer borrowing and depositing into banks. We are a fractional banking system, and no more lending of money is occurring at a rapid pace. So where does job growth come from? Personal incomes comes from two different things. You grow aggregate incomes via people getting more jobs or higher paying jobs. And if we see that money supply continually growing, then the opportunity or the liquidity pushes people to get better jobs. What drives all of that? Not only is the money supply cause, but it is also effect. Consumption. Expenditures tells us that the consumer, which 70% of our economy is driven by the consumer, is slowing down. Businesses will follow suit. They're not going to sit there and just keep building things and supplying shelves, especially if there's tariffs of 25%. So the consumer themselves believes that there's going to be inflation, that there is going to be an economic halt. They're no longer spending. They're saving. They're getting ready. That is a catalyst for a stock market that will shudder. This is the yield curve. And this is one of the things I keep staring at, saying it's not adding up right. So the yield curve, for those of you who don't know, and I am going to put some explainer videos out on this. I'm trying to put out one video per week over the course of the next 10 to 15 weeks on explainers on various aspects of the economy, so you have a better understanding of what goes on in any particular area and how that affects those economic indicators, how they affect the stock market. So this is the Treasury yield curve. And the yield curve breaks down interest rate levels for the US Treasury, what the Treasury has to pay over the course of various time frames. When you consider, say, the 10 or the 30, all right, it's very difficult for us to kind of encapsulate where the belief will be for the economy 10 years from now. That's a long way to project. 30 years is even longer. So you would ask for more interest rate levels because of the longer dates. But if you look, the 1 month, 2 month, 3 month, 6 month, 1 year, and 2 year are higher than, say, the 3, 5, or 7, or 10. Now, the 10-2 spread is still positive. The 10 is higher than the 2 for now. If we continue to see the 10 falling while the short-term interest rates remain lofted, that tells me as a signal that, boy, does the economy believe we're going to see, or market participants laid out. We're not seeing that just yet. What we're seeing is that there's a belief system that inflation will get in check. Now, we're going to get these tariffs, and that's going to push up prices, but I don't believe the Federal Reserve pushes for higher interest rates because of the tariffs. They have a dual mandate, price pressures and full employment. This is a one-time thing. And so the Federal Reserve won't necessarily need to push for this because it's not like consumers are just rushing and buying every roll of toilet paper on the shelves. There's something else going on here. And because of that, because of the shocks, the Federal Reserve may have to step in and lower interest rates, which brings us to the front end of the yield curve. I believe the Federal Reserve is going to be forced to lower interest rates faster than they want to because of the consumer seizing up. So there's a balancing act there, and I believe that the Federal Reserve is going to have to move. Simultaneously, because of that movement, you may see savvy investors rushing in to buy that front end because it is more dear than, say, the 10. That is sort of a motivation of why I'm looking at SHY ETF as well as TLT ETF. I believe that they both will see progressively higher prices, but that there's going to be a spike in the front run, the front months, more so than the long term. But eventually I still am targeting long-term interest rates moving lower and TLT ETF moving higher. Now, I know a lot of you guys are following my content specifically because of my TLT, but I really want you to start taking a look at SHY ETF. SHY ETF is the ticker symbol there. I think he's going to smash everything as much as he possibly can. 25% tariffs. I truly believe that the 25% tariff is a cover to hit Canada with a 10% oil tax so that Saudi can import more or export more into the United States, and I believe there's a backdoor payment. And that everything else is nothing more than noise to cover up what he's actually doing. The man put out a frickin' meme coin the day before he took office. There's nothing that's below him. Fine, that's policy. That's what I see what's happening. The problem with that is, although Saudi Arabia would be able to sell more oil because they're going to be more competitive against Canada, the economy is going to tank, which means the price of oil is going to fall anyway. So they're going to be selling more, but at a lower price. So who wins there? It's an interesting thing. Here is a look at SHY ETF. This is the weekly chart. And if you look, it goes all the way back to 2019. Now, here's the thing. Federal Reserve dropped interest rates, short-term interest rates, near zero. And yet the price of SHY ETF is higher than what you could have gotten during COVID. The reason why is because I think a lot of people are front-running and rushing into these interest rates. And it's a matter of what would you pay in order to get this. Remember, there's an inverse relationship between price, what we're looking at in the chart, versus interest rates. Interest rates right now on the short end are very high relative to the 10. So you're getting a lot of people pushing in, whereas you've not seen necessarily movement downward in short-term interest rates. So on the one hand, I'm very interested in putting a lot more money in, but again, what goes on with the budget? 10 days. I can hold out for 10 days. I'm sitting on a tiny position. I could buy a cup of coffee. I mean, it's a tiny position for my size. I'd like to go 10 to 25x that size. But that budget. You know the Democrats are going to, in the Senate, the Democrats are going to stand up and say, nope, we're just going to talk and talk and talk and talk until anything gets killed. But it only takes one or two in the House of the Republicans to stall any bills there. And Republican congressmen are getting their feet held to the fire. So there might be something there as well. So there's a lot of interesting dynamics happening in Washington, which could mean they don't meet that 10-day time frame. And one thing's for sure, the Dems are not going to allow consensus, a clean bill, simply because that would mean they're okay with what's going on with Doge. They're ready to pick a fight. But it's up to Republicans ultimately. Let's see how it plays out. In the meantime, I'm not going to rush into SHY ETF simply because of what we're looking at here. I don't like buying things at the top. This is clearly at the top. This makes me nervous beyond belief. It goes against a lot of my experience. What if it's the really, really top? But I believe that the economy is going to get shattered. Money will rush into these treasuries. The only thing that's really preventing me is the potential of a government shutdown. I'll keep you guys posted. SHY ETF, SHY ETF, along with TLT ETF. I see there's some opportunities there.